What if a financial crisis, unfolding thousands of miles away, was already changing how much you pay for food, fuel, or even your future investments? Most people hear the word Nigeria and they think of a distant economy with problems that feel local and contained. But that's a dangerous assumption. Nigeria is neither small nor isolated. It is one of the largest economies in Africa, deeply connected to global energy, food, and financial systems. When an economy of this size begins to fracture, the effects do not stop at its borders. They move through markets, prices, and portfolios in ways that are easy to miss until the cost shows up in your own life. Today we're talking about Nigeria's economic crash and how it will hit you in your wallet. To understand what is happening in Nigeria today, we need to start with the numbers. Over the past 2 years, the cost of fuel in Nigeria has exploded. Petrol prices have risen by nearly 500% in under 24 months. What once cost a few hundred naira per litre now costs several times more. Fuel matters because it powers transportation, generators, farming equipment, and small businesses. When fuel prices rise this fast, the cost of almost everything else follows. This surge in fuel prices feeds directly into inflation, which measures how fast prices are rising across the economy. As of 2024 and 2025, Nigeria's inflation rate has climbed above 30%. That means, on average, prices are rising by nearly 1/3 every year. Food prices are rising even faster, with food inflation approaching 40%. When food inflation rises this quickly, households are forced to spend a larger share of their income just to eat. At the same time, Nigeria's currency has suffered a dramatic collapse. Just a few years ago, the naira traded around 460 to the US dollar. Within a short period, it weakened to nearly 1,700 per dollar. Currency value matters because Nigeria depends heavily on imports, including fuel, machinery, medicine, and food inputs. When the currency weakens, imported goods become more expensive immediately. Soon after, local products rise in price because transportation and production costs increase. This loss of currency value acts like a silent tax on everyone who earns and spends in naira. These price pressures help explain why poverty has expanded so rapidly. More than 60% of Nigerians now live in what economists call multi-dimensional poverty. This term goes beyond income alone. It includes access to food, clean water, healthcare, education, housing, and electricity. A household may earn some money, yet still lack basic services that define a stable standard of living. When inflation rises faster than wages and public services weaken, multi-dimensional poverty spreads quickly. At this point, a reasonable question arises. How can an economy be in such distress while official data shows economic growth? Nigeria's gross domestic product continues to grow on paper, often reported at about 3 to 4%. GDP measures the total value of goods and services produced in an economy. It tells us how large the economic pie is, but it does not tell us how that pie is shared. When population growth is high and prices rise faster than incomes, GDP growth can exist alongside falling living standards. In simple terms, the economy can expand while most people are poorer every month. This leads us to the core issue that defines Nigeria's current situation. The country is experiencing a structural economic breakdown. And if you ask why, well, Nigeria's economic foundation was built around one central pillar: crude oil. For decades, crude oil has served as the main source of foreign exchange, which is the hard currency a country earns to pay for imports and service international obligations. At its peak, oil accounted for roughly 90% of Nigeria's export earnings and around 80% of government revenue. When one resource dominates earnings at this scale, the entire economy revolves around it. Oil revenues did far more than fill government accounts. They funded national budgets, paid for imports, and helped stabilize the currency. When oil prices were high, dollars flowed into the country. These dollars supported the naira, making imports cheaper, and allowed the government to spend more. This created a sense of economic strength that felt permanent. In classrooms, this would be called oil dependency. It is similar to a household depending on a single paycheck. When that paycheck arrives every month, spending feels safe. When it weakens, everything becomes uncertain. This reliance created what economists call revenue concentration. Government income comes from a narrow source rather than many sectors. In Nigeria's case, oil revenues crowded out incentives to develop manufacturing, agricultural processing, and industrial exports. Instead of building factories that transform raw materials into finished goods, the economy focused on exporting crude oil and importing almost everything else. Infrastructure such as power supply, transport networks, and industrial zones received limited long-term investment. Manufacturing share of GDP remained low for years, often below 10%. Underinvestment in diversification weakened the economy quietly. Diversification means spreading economic activity across many sectors so that no single shock can destabilize the whole system. Without diversification, productivity growth remains limited, and job creation stays weak. Manufacturing typically absorbs large numbers of workers and builds export capacity. When it remains underdeveloped, employment opportunities shrink and income growth becomes uneven. Over time, this limits the economy's ability to generate stable and broad-based prosperity. Institutional quality also played a central role. Corruption, weak institutions, and tax leakage drained resources that could have strengthened economic foundations. Tax leakage occurs when governments fail to collect revenue efficiently due to evasion, poor administration, or informal activity. Nigeria's tax-to-GDP ratio has remained among the lowest globally, often below 10%. This meant that even during oil booms, the government relied heavily on oil income rather than building a strong domestic tax base. Weak institutions struggled to enforce accountability, manage public investment effectively, and channel revenues into productive uses. During periods of high oil prices, these weaknesses were masked by oil revenue. Growth numbers looked impressive, budgets expanded, and consumption increased. This created the illusion of growth. Rising revenues from one external factor created expansion without strengthening the underlying structure of the economy. When oil prices rose above $100 per barrel in the early 2010s, GDP expanded and foreign reserves increased. Yet the economy's core remained narrow, import-dependent, and vulnerable. The next major blow to Nigeria came after 2014. That year, global oil prices collapsed. Crude oil fell from over $100 per barrel to below $40 within a short period. For an economy built around oil revenue, this shock hit public finances immediately. Government income dropped sharply while spending commitments remained high. Salaries, fuel imports, and basic operations still needed to be paid. This gap between income and spending created large budget deficits. Nigeria's deficits widened rapidly after 2014 as oil revenue failed to meet expectations. To fill this gap, the government turned to borrowing. Nigeria's total public debt began to rise steadily year after year as deficits became the norm rather than the exception. The way this debt was used worsened the situation. Instead of funding projects that increase productivity, such as factories, transport systems, or power generation, much of the borrowed money went towards consumption. Consumption spending covers immediate needs like wages, subsidies, and administrative costs. Productivity spending creates assets that help the economy grow over time. When borrowing funds for consumption, it provides short-term relief without strengthening future income. This meant that each loan solved a present problem, while quietly increasing future pressure. Budget planning deepened the problem. Each year, government budgets were built on optimistic assumptions about oil output and oil prices. Budgets often assumed production levels close to 2 million barrels per day and prices well above market reality. When actual output and prices fell short, revenue targets were continually missed. These unrealistic assumptions produced repeated revenue shortfalls, meaning the actual income is far below what was planned and budgeted. Each shortfall forced the government back into borrowing to close the gap. This pattern created what economists call a debt spiral. A debt spiral begins when borrowing becomes the main solution to recurring deficits. First, the government borrows to cover spending gaps. Over time, total debt rises. As total debt increases, the cost of servicing that debt grows. Nigeria's interest expenses began to consume a growing share of government revenue, in some years exceeding 25%. This meant that a large portion of income was spent paying lenders rather than funding public services. Less money remained for health, education, and infrastructure. These sectors rely on consistent public investment to support long-term development. When funding shrinks, hospitals struggle, schools deteriorate, and infrastructure projects stall. This reduction weakens human capital and limits future economic potential. Over time, the economy's capacity to generate revenue declines further, reinforcing dependence on borrowing. The cycle becomes self-reinforcing. Borrowing increased debt. Higher debt raised interest costs. Rising interest costs reduced available funds for a productive investment. Weak investment slowed growth and reduced revenue. Lower revenue widened deficits again. Each year, escaping this cycle required stronger growth or higher revenue. Neither arrived at the scale needed, and of course, by the late 2010s and early 2020s, Nigeria found itself trapped. At this stage, the crisis stopped being only a domestic issue and began to matter far beyond its borders. And here, you need to think like global investors. Investors move capital across countries based on one key factor: trust. Trust that rules are predictable. Trust that policies will remain stable. Trust that returns can be earned and safely taken back out. In Nigeria, that trust weakened as policy uncertainty increased. When uncertainty rises, investors respond quickly. They reduce exposure. They delay new projects. They begin pulling money out. This process is known as capital flight. Capital flight does not happen in only one place. It is a systemic shock. It affects bonds, equities, and direct investment at the same time. Direct investment includes factories, infrastructure projects, and long-term business expansion. As confidence weakened, foreign investors reduced holdings of Nigerian government bonds and local stocks. When investors sell bonds, prices fall and yields rise. Bond yields matter because they determine how expensive borrowing becomes. As Nigerian bond yields climbed higher into the high teens and above, borrowing costs increased sharply. Higher yields signal risk. They tell the world that lenders demand more compensation to hold Nigerian debt. For the government, this meant that refinancing old debt became more expensive, adding further pressure to public finances. Capital flight also placed a strain on foreign reserves. Foreign reserves are the stock of foreign currencies held by a country's central bank. These reserves are used to pay for imports and support the currency. As capital left and export earnings struggled to keep pace, and reserves faced pressure, lower reserves reduce a country's ability to absorb shocks and defend financial stability. Credit rating agencies responded as well. When fiscal pressure, capital flight, and reserve stress increase, sovereign ratings are downgraded, further raising borrowing costs further and discouraging conservative investors such as pension funds from participating. This reinforces the cycle of reduced capital inflow. Now, here is where the global connection becomes clear. Nigeria is not a small, isolated economy. It is Africa's most populous country and a major commodity producer. Financial instability in such an economy sends signals across global markets. Investors use large emerging economies as benchmarks. When risk rises in one major market, capital is repriced elsewhere. This repricing affects global portfolios. Fund managers adjust exposure to emerging markets as a group. When Nigeria appears unstable, risk premiums rise across Africa and other developing regions. A risk premium is the extra return investors demand to compensate for uncertainty. Higher risk premiums raise borrowing costs for multiple countries, even those with stronger fundamentals. Commodity markets feel the impact too. Nigeria plays a role in global energy and agricultural supply chains. Financial instability can disrupt investment in production and logistics. This affects supply expectations. When supply becomes uncertain, prices respond. Global commodity prices incorporate risk from major producers. These price shifts influence inflation expectations worldwide. Supply chains also react. Multinational companies assess country risk when deciding where to source materials or locate operations. Rising instability increases insurance costs, financing costs, and operational risk. These higher costs are passed along the supply chain and ultimately reach consumers in other countries. This brings us to the broader lesson. Global finance is interconnected. Capital does not stay confined within borders. When trust collapses in one market, global capital reprices risk elsewhere. Investors become more cautious, volatility increases, asset prices swing more sharply, borrowing costs rise across regions. Nigeria's economic collapse is no longer only a national problem. It has become part of a global cost chain that reaches households, investors, and consumers across the world. Let us begin with food and energy prices. Now we know that Nigeria is a major producer of crude oil and an important agricultural market in Africa. When financial instability disrupts production, investment, or export capacity, global supply expectations change. Energy traders and commodity markets price in risk. Even small disruptions can push prices higher. Higher energy prices feed directly into transport costs, food production, and electricity bills worldwide. When fuel becomes more expensive, everything that moves becomes more expensive. Food markets react in a similar way. Nigeria is both a producer and a large consumer in regional food system. Financial stress reduces investment in farming, storage, and logistics. That affects supply chains across West Africa and beyond. Global food prices respond quickly to uncertainty. Higher food prices hurt households everywhere because food is a basic necessity that cannot be avoided. Now consider financial markets. Many people assume global market volatility affects only traders or large institutions. That is not true. Market volatility refers to how sharply asset prices move up and down. When volatility increases, long-term investments become less stable. Pension funds, retirement accounts, and insurance portfolios are exposed to this instability. If markets swing more violently, returns become unpredictable and long-term savings suffer. Pressure also spreads to other emerging markets that are perceived to share similar weaknesses. Whether their economies and government institutions are actually similar or not, investors often group developing countries together when assessing risk. If one large economy struggles with debt, currency instability, and weak institutions, investors reassess exposure to other developing economies as well. This can trigger broader capital outflows and financial stress. Countries that had nothing to do with Nigeria's decisions still face higher financing costs and reduced investment. This leads us to inflation. Global inflation does not come from one source, it builds through repeated shocks. Currency crises in large economies raise import costs, disrupt supply chains, and push up commodity prices. These pressures accumulate. Inflation becomes harder to control because it is reinforced by multiple regions experiencing instability at the same time. So Nigeria's crisis is not unique. It is a warning about debt-driven growth, weak institutions, and delayed reforms, and most of all about overdependence on a single revenue source. Similar patterns exist across multiple emerging economies, and if one economy can transmit costs so widely, what happens when several do at once?